Hello all, and welcome to another edition of Nucleus Investment Insights. This week we are having a look at a stock market showdown, earnings momentum versus valuation. And I think this is where a lot of it comes back to. We've spoken before and sort of did a bit of a deep dive last week into terms of long-term earnings and long-term valuations and where they sit. I wanted to sort of focus back in this week and really look at this idea that saying, well, how much is valuation important, and how much is earnings important, and where does where does the rubber hit the road in terms of the two, and what can we see in terms of those? Because there is certainly, while values are high, there is certainly a lot of earnings momentum out there, and we've had the last two reporting seasons after, I don't know, maybe 2 or 3 years of quite disappointing reporting seasons. The last two reporting seasons have been pretty good. And so, just wanted to sort of compare and contrast there and try and work out where we can go. So, just a reminder that what you hear today is general in nature. Nothing in here is personal financial advice. If you do want some help, jump on our website and you can register there, and we can have a talk through what your personal issues might be. In terms of your so without sort of too much further ado, I'll sort of jump straight into it. The first one I wanted to look at was this idea, and I'm using just to highlight as well, a lot of the charts today are from Yardeni, who's got a pretty good resource in terms of US market data, and so I'm using a lot of his stuff, and then I'll dig into some of the global market research and things like that a little bit later on. So first is this idea that, look, where are we seeing in terms of these price to earnings ratios, and in particular sort of that split between the large cap, mid cap, and small cap within the US. So we can see that the mid cap and small cap US is it's high relative to the last couple of years, but in terms of the broad spectrum of over the course of that entire period, it's actually not too bad. Whereas the large cap part of the market is really where we're seeing most of the expensive. And that's really what drives that market up, because the large cap, when you look at the overall S&P 500 or overall US market, the largest stocks make up sort of 80% plus of that in terms of weight. And so when they're expensive, the entire market is expensive, and you can sometimes see some variation within that. So there might still be some opportunities, I guess, even though the markets are expensive. There's still some arguments for some opportunities within the sort of mid caps and small caps. And then secondly is this idea that on the large cap stocks, are we actually seeing enough earnings growth within those that would justify where we're seeing prices at the moment? So another way to look at this, and this is a very, I think of this as a very crude way to look at growth versus the earnings side. Sorry, I've just realized that chart can't quite see some of the things on the right hand side of that, but what it's showing here is what's called a price earnings growth ratio. And effectively what you're doing is taking the price to earnings ratio and then dividing by the growth. And so, for example, if you have a price to earnings of 15 times and you've got a growth rate of 15 times, then you'll come out at 1 on this ratio. So usually the price to earnings is a bit higher. And there are some issues with non-linearity and all these other things like that sort of go into to why this might not be a useful ratio in terms of the absolute numbers that you're getting, but I think in terms of trend and certainly versus history, it sort of gives you that idea about where we're seeing today in terms of the growth expected versus the value of the market. And as you can see, like, we're actually sitting dead center. So, from this perspective on a price earnings to growth ratio, you're at 1.25 or closing in on 1.3. That's been much higher in the past and much lower as well. We're actually sort of sitting. So that's sort of in essence, although I have concerns about this measure, sort of sums up this idea that are we in a position where the growth rate we're getting out of company earnings is enough to justify some of the share price successes. If we look then, so within that, then I want to sort of jump in and sort of have a bit of a deeper dive into these earnings numbers that we're seeing. Now, I've got a chart up showing, and I'll just sort of describe it for anyone sort of listening in on the podcast. It's what we're looking at is the forward earnings per share growth. Forward earnings per share, so 12 months forward. So it's just a rolling number. You just keep getting a little bit more of next year and a little bit less of this year, sort of every day that goes past. And then there's an historical number, and then all these little blue lines on this graph is sort of showing where the first forecasts were and where they ended up. So the red line is the one to focus on. As long as that's going up, that's where your 12-month forward earnings are going up, and that's that sort of expectations coming through from analysts. And we're in this period now where it's clearly going up. There's I guess if you're if you wanted to try and draw some negativity into it, you could say there is a slight tinge of it maybe coming off a little bit at the end, but it's pretty strong growth relative to where we've seen at any time, over the last sort of 30, 40 years. The purple line then shows the actual numbers, so just making sure that that does sort of add up. And I guess the thing to note with this is, if you're looking at the blue lines, they usually trend down. So usually what we're seeing within that is you usually see that analyst forecasts come out and they're a little bit too optimistic. And then over time, those numbers come back down to what the actual levels will be. But, and say that we just picked sort of between 2010 and 2000 and maybe 16 or 17 to sort of to illustrate that, is over that whole time period, we had those earnings forecasts coming down, but the lines were rising, like the actual 12-month forward numbers are rising. And what that means is you're looking at, say, analysts coming out and saying, oh, we think there's going to be 12% earnings growth, and then earnings growth comes in at 7%. And so, it's worse than 12, but it's still up on the prior year. And that's that, I think there's that part that sometimes gets missed in terms of that underlying, that underlying numbers that are coming through. So really, we're sort of focused in two ways. One is yes, we want to know whether we're seeing enough in terms of downgrades that's actually going to bring those forward lines down, or is it just more about bringing what might have been over optimistic forecasts back to something more reasonable? And so if you look in the most recent periods, the 2022 numbers in particular, that was where we saw enough in the way of downgrades that it actually threw the whole thing off track. And that was what really led to that market coming back sort of 20%-ish in the US, was the fact that earnings started to turn. And what we've been seeing in recent years, while they've been a little bit disappointing, the earnings, they've actually haven't been, the line's still been rising. And there's been a big element of, even though, so if you look back, say, between 6 months ago and 18 months ago, where what we saw was earnings themselves were pretty disappointing and coming in basically at close to zero in terms of growth. But as they'd come in, the expectations for future growth kept on improving. And so now we've got them both. We've got actual earnings starting to rise and that coming through. And you can see the sort of last line on that, the 2024 numbers. We've seen a little bit of downgrades, but it's been pretty flat, and it's been a pretty reasonable outcome relative to what you've seen in other years. And 2025 looks the same. Like, it's just the growth rates are looking pretty strong for 2025 now, with very little in the way of downgrades. So, the flip side, I guess the more negative argument you'd have is that if you did draw out the numbers and you looked at what you often see as a net earnings revisions index, And so that's talking about the number of companies revising their earnings up versus the number of companies revising their earnings down. And that looks a little bit negative. On that basis, when these lines are below zero, you're seeing more downgrades and upgrades, and vice versa. So the thing is, though, this chart is a little hard to sort of reconcile sometimes with what you've seen on the prior one. So let's say I look at, say, from 2020 onwards, we saw a whole batch of upgrades for the first, throughout 2020 and 2021. But then pretty much since then, it's been downgrades or very slight upgrades. But then if we go back to that prior chart and just look at the earnings forecasts, they've been rising. Yes, you had that 2020 sort of scoop upwards and then a little bit of the fall downwards, but they've been rising despite what you say, were slightly negative or at least benign sort of numbers coming out on the earnings growth revision. So I guess I do look at the net earnings revisions, but it really depends upon your starting point. So when you've started with forecasts of say 5 or 6% growth, and then you're seeing downgrades, that's a lot more important than if you're starting with what we've been starting, sort of 12% plus growth, and you're seeing downgrades to sort of higher 11s at the moment. So that's sort of obviously much less concerning from a big picture view about valuations. The other thing you can look at is the same types of measures, but on a sales basis. Now, keeping in mind that sales is a much less volatile series usually, and that's where we can see, with these ones, certainly in the last couple of years, really there's been very little change at all in the sales forecast. They've been very steady, and so most of that sort of come through at the earnings has been a little bit more volatile, but the sales forecasts have actually been as steady as we've seen in any period. And then if you dig that through, you can sort of turn those into growth rates, in particular for these revenues, and they look a little bit. Obviously, prior years look a little bit more volatile on those revenue growth rates. But what we're seeing is that we're really stuck around that 5% revenue growth for 2024, 2025. 2023 came in at sort of 2% growth. We still actually ended up with some pretty reasonable earnings on that. And ironically, the 2022 where we saw 12.5% growth, that was actually, we saw some a lot in the way of poor earnings on that at that time, and that's sort of because you're getting this because of the margins, because the earnings margins that are coming through. So just to sum where we've come from and what we're looking at so far is we're saying, well, yes, valuations look high. On the second part, though, earnings look pretty strong, and if you do sort of an adjusted ratio between the two, you sort of end up in the middle. I think that probably overstates it. I do think there's things that are still looking a little bit expensive relative to the growth, but it's nowhere near the sort of extreme levels. And I'm going to jump a little bit more into that after this message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the next thing I wanted to sort of look at is this idea of price to sales ratios. So I'm pulling out in this one sort of, there's a couple of major things we use in terms of big picture. So we look at price to cash flows, dividend yields, and dividend yields adjusted for buybacks, which I'm actually not going to go into detail here just for time basis, but they're sort of telling largely the same story. There's a price to book ratio that used to be a really common one. I haven't even bothered showing that just because I have quite large reservations about how that's calculated and how the changes have happened over time. So look for last week's, that sort of digs in a bit into that. But the other one, this price to sales ratio. So what I've got showing up here now is the forward price to sales ratio versus the forward price to earnings. And so while the price to earnings ratio, below what we saw in the tech boom, it's below what we saw in that sort of post-pandemic, the boom post-pandemic, whereas the price to sales is actually hitting all-time highs relative to this. I just want to note within that price to sales, that is a confusing measure, particularly over time. And this only has like a, whatever it is, 20 years worth of history, but there's especially so the further back you go in time. And the reason why is because markets are, again, quite different now to what they used to be. What you find quite often and increasingly so in recent times is that companies are outsourcing a lot of the lower margin parts of their business. So if you look at a company like, say, a Boeing or someone like that, a large sort of manufacturer of some sort, 50 years ago, they used to do most of the manufacturing themselves, like those, and they'd buy some things in. They were pretty integrated. It was this company that, doing a whole bunch of things from very basic manufacturing all the way up to the high-end design. What has been increasingly a factor, especially over the last 20 years, is outsourcing the lowest margin things to other people. And whether that's private companies or whether that is to China or places like that. And so what that means is if you're sitting there with I've got this manufacturing division, for example, that's, say, it's earning, 1% margin on what it's making in terms of it's making something quite expensive, but then it's selling it for this quite low cost. Whereas I've got my engineering division or the design division, which is actually, for every dollar of sales, is actually picking up, 30 or 40% margin on that. 50 years ago, I was looking at this company. There's this combination of these two, some very low margin business and some very high margin businesses. Whereas today, what we're looking at is companies that where the margins are much higher because you've just sold off the low margin parts, or you might have had property within 50 years ago, you might have owned a lot of your properties, and then now you've actually got rid of them and leasing them back, and so your return on capital has improved, and so there's these ideas that just the structural changes in companies over time makes a difference to that. And then secondly, so that's one part of it, and then the second part is just the switch between manufacturing and services. And so again, I'll pick on NVIDIA, which is one of the biggest contributors to this, is one of the largest stocks in the market. Is NVIDIA is not much of a manufacturer at all. Like almost all the manufacturing gets done by the Taiwanese semiconductor manufacturing, and NVIDIA really is the design and the sales and other parts around that. So the question is, are they really a manufacturer, or are they really more of a service company that fits into that? And if you look at the margins that Taiwanese semiconductor manufacturing, which isn't in this index because it's listed in Taiwan, has versus NVIDIA's margins, it's chalk and cheese. NVIDIA earns these 50-60% margins. And so if you're only looking at sales, especially over time, I think you're getting a bit of a dud view. Sales can be useful in terms of comparisons, making sure, as long as you're looking at like-for-like companies. But I think the price to sales is overstating it. And just to illustrate that in another way, I've just got the sectors of the S&P 500 sort of broken out into their constituent parts, and you can see that for anyone sort of listening into the podcast, it's pretty complicated chart. There's sort of 11 different lines and series of these margins that companies making, but it's pretty clearly most of them are rising sort of over the sort of 20-year period that's shown. And if I picked on the highest one at the moment, which is the information technology, and again, highly influenced by NVIDIA's numbers within that, but it's sort of gone from margins of 10 to 15% 20 years ago to margins well over 25% now. And so that's sort of consistent with that's they're obviously doing the best, but there's a lot of other sectors within that that have all seen quite significant increases in margins as well. So so one more reason why we're not, we don't tend to look as much at price to book and price to sales ratios as what we once used to. And then the other thing within this is that this is sort of illustrating that same thought, in terms of that earnings momentum, and if companies can keep improving their margins beyond this, is then you can keep seeing that earnings coming through. So the next part then is I thought was interesting as well. It's sort of telling the same story. There's a group of, so some people, and including ourselves, like to look at markets and break companies into the various components. And one of the most common sort of three components is breaking it into growth stocks versus value stocks versus quality stocks. And what do we mean by that? We mean, well, quality stocks are the stocks which are earning high margins, getting good returns on equity, and particularly equity invested. And so they're sort of high quality. Your Warren Buffett has a high, a wide moat. And so and the idea, I guess, is if you see those companies and you see the valuations are high for those companies, then you sort of make the assumption that, okay, people are paying for that quality. So you've got that quality group, and if valuations are higher within that, then they're high because people are paying for it. Then you have the low valuation stocks, and these tend to be lower quality, and you tend to see that they don't earn particularly high margins, and you get that they tend to be quite cyclical. So these are the companies that find it quite hard to pass on price rises, and they sort of get short periods of time where they can, but broadly they can't. And so they end up being what you call value stocks. And then the other component, which is all the stocks that are left. So they tend to be stocks that, well, they're not cheap stocks. So they're either average or above average in terms of price, but they don't fall into the quality camp. And so the expectation then is these must be growth stocks. So that's the only reason people are paying extra for it, is because of whatever growth is expected. And so when you break those up, it used to be this flick between value and growth, and sort of the you'd get that quite famous in the 2000s. You had that big divergence between value and growth, and which then, as the tech wreck came off, it saw the sudden reversal of that, and it made names for lots of different value managers in terms of how much money they made over that time period for their clients. Basically, as all these others, as the whole market was falling, all these value managers are rising or even staying steady or rising because of the because they had all these value stocks within that, and sort of made their names. But since then, and particularly since the 2008 financial crisis, it's been one-way traffic for those value stocks. They really have just declined year after year after year. A brief respite at the end of the sort of inflation boom, as they finally got to pass on prices, as everyone, all companies got to pass on prices. But it's sort of that further illustration of what I'm talking about, and saying the companies that are earning these low margins tend to be these value stocks, and they're the ones where we just haven't seen the price rises as well. So if you can see the earnings forecast coming through and the earnings growth coming, then there's a reason to be paying up for stocks. But the flip side is also true in terms of that. That without that growth, it's pretty hard to justify paying valuations near the market levels at the moment. Flipping to another measure, I just wanted to looking back at the Fed's stock valuation model. So I mean, this is a bit of a rule of thumb. It's not sort of it can diverge for large periods of time. And basically what it is looking at the difference between the the US 10-year treasuries and the forward earnings yield. And so you can see this line is just showing the two separated. The more interesting line is the one that shows the comparison between the two. And at this point, the Fed model is basically saying the S&P is about fair value. So theoretically, it's undervalued when it's the yields below that line. So when you look at those, when you compare those two series we had on that prior chart of the Treasury bond yield and the forward earnings yield, if the forward earnings yield is below the Treasury bond yield, then it's undervalued, and if it's above, it's overvalued. And we're back to basically square at the moment. So slightly undervalued on this measure. Having said that, though, it's been 25 years since we were last here, and so there can be some question marks on valuation metrics where, for example, if you're using this as your sales tool and you expect it to come back, then 25 years can be a long time to be holding particular views in one way or the other. And so the Fed valuation sort of model says something similar. And then I wanted to dig a little bit more into some of the earnings growth figures that we're seeing and break down some of the sectors, and then look in more detail at the valuations side just after this message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So if we go sort of breaking back and looking at the global markets now, 6 months ago we were looking at 12% growth. Now it's looking at being at 11, high 11s, 11.8. So it's come down, but it's pretty significant in the whole scheme of things. So this is for 2025 numbers, which usually 6 months ago to see earnings growth expected of sort of 10 to 13% is not that happens often. Like we often see that far out. But then when it gets closer, you start seeing some pretty significant downgrades. And by this time, we're whatever it is, a month away from the start of the next year, you'd usually start to, if it was looking like being a bad year, you would have usually seen some pretty decent cuts to those numbers by now, and we haven't. So I think there's it's obviously something to keep an eye on, but those numbers are certainly holding up much better than they would if you're looking at a period where we were going to see some reasonable downgrades. How does that flow through into earnings figures? Well, there's if we look at the sort of global price to earnings ratios, and there's two ways. Well, the most common way I look at it is to strip out our financials and resources and then look at those separately, mainly because of the ratios we see from that are quite different to what you might see in others, and also you do get the element, particularly in say resources, where high valuations quite often mean it's actually looking at depressed earnings, and vice versa. You've got to say it's the oil price, and the oil price runs up to $120. Is the earnings suddenly look really, really good, but people are looking at it going, hey, those earnings aren't going to last. And so they're actually paying what a low price to earnings ratio, so it might look really cheap. And so so if you strip them out, I think you get a much better feel for longer term the right levels to be looking at. So on a global basis, just about 22 times. It's a little bit below what we saw sort of that post-pandemic. And keeping in mind that post-pandemic sort of lasted for a year or so at those levels. And then still below what we saw in the tech boom, which was a pretty extraordinary event. Then if you look back and say, well, how does Australia look? Well, Australia looks expensive, 24 times, so well above that sort of world average, so 10%, more than 10% above. Now, keep in mind this is excluding financial resources, and then within the US, you're looking at sort of 23, almost 24 times, which is again just sort of really at that same peaks we saw post that pandemic. And I think it's worth noting, so that's sort of a little bit above the 80th percentile. Having said that, though, what we sort of discussed last week was this idea that, look, how much, if we're looking at tax cuts and assuming that those tax cuts will come through, and they probably won't happen until late 2025 or into 2026 numbers, is that if markets are sort of price those, there's probably 7% growth at least just in the tax cuts. Can probably take you out to 10 once you look at some of the other things that are going on just in terms of reduced regulation and things like that. So if you knock 10% off that number, it does come back to sort of the 75th percentile in most cases there. So to keep in mind, I guess Australia doesn't have those same tax cuts coming through, or certainly not for most companies. But the US, you can sort of come back and say, well, you get those tax cuts through, put you at say this, between the 75th and 80th percentile. Given how growth looks, yes, it's expensive, but maybe given the growth, it's a more reasonable outcome at that point. So that's where we're looking at for those. If you separate it down again and look at some other countries, and now what I'm doing is I want to dig into Australia a little bit, just those individual sectors. And now what I'm doing is I'm saying take the forward earnings for Australia and compare it to the forward earnings for the world. And so it's basically in line, which is a little bit, Australian earnings, 0.97. 0.97 on the overall, but actually that's not the right measure. The one I want to focus on, the one that's the top right, ex banks and resources. And so it's about 1.09 times, so 9% above the world, which is actually pretty typical for where it's traded in recent times. Having said that, though, it's quite the Australian lines is a bit weird insofar as if you look back to sort of the 2000, the last sort of tech boom, Australia was trading very much at a big discount, so 20% discount to the globe. Australia looked very much as being just a resources company and a country, and not an old world, not having the companies or the technologies that sort of into those booms, and and then in recent years it's been considerably above that, and a lot of that's been the valuation of some of the companies like CSL and I guess some of the oligopolies that have managed to pass on quite a lot of prices within Australia. So that's Australia looks about average, but I guess there's question marks about where that right level should be for that line. If you look at the Aussie banks versus the world banks, like we're off the end of the scale. You're at the 99th percentile or something like that, well above the 90th percentile. Twice the price of European banks. Maybe that's because the Aussie banks are close to the regulators, and they're getting sort of extra marks for that because they figure the regulators will save them in times of trouble and won't punish them when they go to excesses, and that might well be true, but it's certainly true that they're extremely expensive versus any prior measures we've seen in the Aussie banks. Jumping to some other countries, if you look at Europe, and actually this is a Eurozone, it's really cheap, and so versus where it's traded in the past. So it's sort of at the other end of the spectrum. Now, some of that's justified. Again, it's this idea of the growth rates. A lot of the big European companies are particularly in Germany, are related to the auto industry, and even France has got a few as well. And they're having a tough time of it, and really facing some significant competition out of China, and question marks about driverless cars and all these other factors going into that as well. So some of that's justified, some of that's not, but certainly Europe looks very cheap relative to the rest of the world, depending upon what you want to buy. But that flows through into Europe. Eurozone banks are significantly cheaper than world banks. They're sort of down at 0.6, whereas the average is more like 0.9. So you could add 50% to the valuations to get it sort of back to their more normal levels. And then resources again are significantly cheap. And keeping in mind, I guess European resources tend to be it's more energy than metals there. Then if you look at Japan, similar story to Europe, really cheap on that those earnings, ex banks and resources, again below the 10th percentile. I think there's probably more scope to, well, certainly from my perspective, is to there are some Japanese companies we quite like. They do tend, there is that element of cars as well within Japan, but there are also a number of exporters there, and and values look relatively reasonable out of those. And I think if there's an expectation that we are headed for trade wars and tariffs and other things, trade protections sort of bouncing around, is that that is going to harm Japan, but probably relative to China, Japan's going to end up in a better position. And what I mean by that, I think you're likely to see some big tariffs on Chinese companies, and you're not likely to see the same level on Japanese companies. And so it's a little bit of that argument. Well, okay, they're not going to benefit from tariffs, but actually maybe they get more of a benefit from losing competitors out of China than what they do in terms of the tariff side. So so Japan looks not too bad on that front. So I guess a quick wrap up of what we're talking about there, and what we've been talking about is it's this idea that, look, where are we looking for value? There's a problem insofar as we're looking at markets that are quite expensive. If we adjust for what we think the tax cuts coming through, they're still expensive, but look a little bit better relative to the growth we're seeing. It does match that. You can sort of look and say, okay, I can actually see where I can pick up some growth for these companies, and that might justify the valuations. But that does leave you in these situations where you have to say, okay, we're looking through Japan for cheap companies, or we might be looking through Europe for cheap companies. We need to be we need to recognize the fact that if the companies aren't getting that earnings growth, though, they're not the companies to be paying up for. And so trying to sort of balance that, or find the companies where we do think earnings valuations have been beaten down, and they're going to see stronger earnings than what might be expected. So, in a big picture sense, if you said, oh, look, can I buy stocks at the 75th percentile, and we're looking at what quite possibly is a soft landing economically, interest rates falling, earnings starting to strengthen, and a business-friendly government just about to take the reins in the US, you would usually look at those and say, well, that's a good time to be buying stocks. And that's the reason why we're sort of, we still have a big investment in stocks. The question is, what can, there are things that can knock that off. Absolutely, there's a whole range of different things, but we really need to keep focusing back into those fundamentals. And for me, until you see the fundamentals turn, and still you start seeing those earnings downgrades coming through, it's going to be hard to see the markets taking a significant fall from where they are now. For small corrections, 5%, maybe even 10%, entirely possible. But those really big downturns you see in financial crises or things like that seem to be quite unlikely without some quite large external shock. based on that. And so for that reason, we recommend you, within our portfolios, we are maintaining our equity weights, very much skewed towards international stocks rather than Australian stocks because of those issues we see for Australia in terms of valuation, but also Aussie dollar issues and just the structure of the Australian economy and the types of companies we expect to do well out of the AI boom. Doesn't really include many Australian companies. Thanks for tuning in. Just a reminder, you can get all our podcasts on your favorite podcast platforms. You can get more content from Nucleus at nucleuswealth.com/content. If you've got any suggestions for topics or guests, then pop them in onto YouTube for us. We're on a bunch of different social media and all the major and minor podcast platforms. Thanks, everyone, and we will see you next week.